In this video, I'm going to be sharing everything that you need to know about UK taxes on shares and more importantly, how you can avoid them. And don't worry, I'm not going to be telling you to pack your bags and move to the Cayman Islands or anything like that. All of the information and tips in this video are completely legal and fully documented on the .gov website that's going to be linked below. So tax. It's something that none of us want to pay, but at the same time, we couldn't live without it. We get taxed from our jobs, our homes, things we buy from the shop. Pretty much everything in this world has some form of tax associated with it. Now, when it comes to investing, there's three main types of tax in the UK that we're going to be potentially liable to pay. First off, we've got stamp duty, we then have capital gains tax, and then finally we have dividend taxes. So let's go ahead and start with stamp duty. Now, first off, this is not to be confused with stamp duty that you go ahead and pay when you're buying a house. This is going to be something completely different. Basically, what stamp duty is in the world of stocks and shares is a 0.5% tax on the total transaction of any UK traded stock, and you'll have to pay this before you receive any shares in a company. Let's take this buy order that I set up for Barclays as an example. This is a UK stock, which means I'm going to have to pay a stamp duty of 31 pence for this trade. One thing to note is that you will not have to pay a stamp duty fee when you go ahead and buy any foreign shares, but as you will be converting your currency during this trade, you're going to be hit with something called a foreign exchange fee. Just looking at this example to buy Apple, which is of course an American stock, as you can see, whilst there's no stamp duty fee here, there is still a 9 pence foreign exchange fee instead. Another thing to note is that you will also pay no stamp duty on most funds that you invest into. So if you're into your Vanguard ETFs, this is once again a fee that you're not going to have to pay. Now, when it comes to avoiding stamp duty, it's really going to come down to what you want to invest into. However, one thing that I will say is do not let this very small tax sway you away from investing into, let's say, a UK-based stock. At the end of the day, yes, it is avoidable, but it's also such a small percentage that if you are investing long-term, in the grand scheme of things, it's never really going to be that noticeable. Next up is capital gains tax. Now, capital gains is basically the profit that you have made from an investment at the point that you decide to sell it. Let's say you invested £10,000 into Apple stock and 10 years later you decided to sell all of that investment because it's gone up a lot and you sold that investment back for £100,000. This means you would have made a capital gain of £90,000 and you could be liable to pay tax on it. Now, how much capital gains tax you're going to have to pay, or even if you're going to have to pay any at all, is very much going to depend on a couple of circumstances. The first thing to remember before anything else is that you will only potentially have to pay this if you decide to sell your investments. The first £12,300 in capital gains that you make is actually going to be charged at 0%, so you're not going to have to pay anything. This is essentially just a free allowance from the government. And then basically anything over that is going to very much come down to how much you earn. So if you're a basic tax rate payer, which means you're earning roughly under £50,000 a year, you will have to go ahead and pay a 10% capital gains tax on your money, and then if you're in the higher brackets, then you're going to have to pay 20. Who said the rich get richer? However, there is a way that you can actually avoid all of this, and it doesn't actually matter how much your gains are or how much your income is either, and that is by investing all of your money within a stocks and shares ISA. This is basically an account that you can invest your money within that will allow you to contribute up to £20,000 every single year, and any capital gains or dividend income that you receive are going to be completely tax-free. Yep, that's right. You could literally continue investing £20,000 every single year for, let's say, 20 years, and no matter how much you make, whether it's 300,000, a million, 2 million, whatever, the money is going to be completely tax-free, which, when you think about it, is really bloody awesome. You can actually only get this account if you do live in the UK, and I have to say, it's probably one of the better things our government has set up to help us out. As you can probably tell, I really cannot stress enough how important I think it is to invest your money within an ISA, and I think that if you are investing less than £20,000 a year, which the majority of people will do, because at the end of the day, that is a lot of money, then you don't really have any reason not to go with one. Just one thing about ISAs that you do need to be aware of, however, the 20k limit that you do get every year will reset. You can't carry that money over. This means that you won't be able to, let's say, invest 10k one year and then the next year have a 30k limit. It simply gets reset to 20 or whatever the government decided to be for the next tax year. Now, I guess one question that you may have is, who do I suggest opening one of these accounts with? And whilst I'm not going to turn this into an ISA comparison comparison video because at the end of the day, every man and his dog is going to have an opinion on who they think is the best. I am going to tell you who I've chosen. This year, I've decided to try out Vanguard as my stocks and shares ISA provider. Last year, it was Hargreaves and Lansdowne, and the year before, it was Halifax. Now, these are certainly not the cheapest ISAs that you're going to find out there, but for me, I feel much more comfortable having my money with a broker that has a long and trusted track record. This video has not been sponsored, neither are there any affiliate links to the providers mentioned. It is very much going to come down to what you feel is best for you and the stocks that you decide to invest into. Next up, we've got dividend tax. Now, if you have decided you are going to go ahead and open a stocks and shares ISA and you keep all of your investments inside it, then just like capital gains tax, you're not going to need to worry about paying any tax on the dividends you receive. You are all good. But even if you don't, there's still going to be some free allowances that you can get your hands on. These allowances work very much the same as the ones that you get with your capital gains. First up, you're going to get the first £2,000 a year that you make from dividends on the government at 0%. And then once again, for basic rate taxpayers, anything that you make over £2,000 in dividends, you will pay an 8.75% tax on. Anyone in the higher bands will pay a 33.75% tax on, and the additional rate people will pay 39 and 35%. These numbers have actually increased over the past year. However, one thing that is worth noting is that whilst the limit is much lower when it comes to dividends, it's probably going to be harder for you to actually pass this free threshold. For example, the average yearly dividend yield for stocks in the S&P 500 sits at 2%. This means that you would have to have a portfolio of £100,000 in dividend paying stocks to be anywhere close to that £2,000 threshold. These are of course just made up numbers, but the point is if you are only just getting started with your investing journey right now and you do not decide to invest in the stocks and shares ISA, it's going to take you some time to get there. So realistically speaking, if you're investing within the stocks and shares ISA, you're all good. If you breach the 20k limit in that account, then you're still good as long as you either don't sell your shares, or if you do, the gains on them doesn't surpass £12,300. And if you do have any dividends incoming, then either keep them in your ISA or remember your £2,000 limit. Now, for anybody that does have any money sat outside of an ISA in investments, then a quick warning is you may be liable to fill in what is called a self-assessment form. This isn't to say you are going to pay any tax. However, if you have sold any shares or you've received any forms of dividend income, even if it's literally like a couple of quid, then you're going to be required to fill in this form. If you don't, well, this is not very good. What you will no longer be doing is avoiding tax. What you will actually be doing is something called tax evasion, which is the failure to pay or a deliberate underpayment of your taxes. This is something that you definitely don't want to have on your plate because it's likely going to lead to either a hefty fine or, in extreme cases, a prison sentence. Now, the lucky thing, however, is that when it comes to filling in a self-assessment form, it's not actually that difficult, especially if it's only your investments that you're dealing with. All you have to do is download the self-assessment form from the gov.uk website, I'll link it below, and fill it in where needed. Or if you are super lazy like me, or maybe you just want to be super certain it's done correctly, then you can always go and hire a tax professional to do it for you. But of course, this is going to come at a premium cost. But having said that, by now you should have everything that you need to know to invest tax-free as a UK investor. All you really need now are some decent shares to invest into that's actually going to make you some money, which is funny I say that because if you're still watching this, then you should definitely go and check out this video right here where I share 7 stocks that I think you should just buy and hold forever for the long term. And remember, if you don't sell, you don't pay.